Great to have you back on. You have a hold rating on the stock. I guess let's start with your takeaways from the results we got yesterday.
Well, I thought it was a good quarter. It came in line. Subs were better in the U.S. on Disney Plus. Hulu was a bit softer, but I thought all in all, it was a quarter that we expected. We knew Park's going to be strong, and they certainly deliver on the U.S. Park side.
So what would it take in general to move you off of that hold rating where Disney is concerned, especially given the fact that the stock has fallen as much as it has this year?
Right. So what we're concerned with is the Disney Plus DTC strategy, right? So if you remember, they changed their strategy from the first rollout investor day to the second. They have a bigger plan with more subs, more genre entertainment content, more sports. And I'm not convinced that's the best idea for Disney, right? So I wonder if, I asked this on the call last night, if they're rethinking maybe their view to come out with such a huge idea, right? They want to be in, above 240 million subscribers. And I'm not sure that's the best use of their capital, right? I think if they played to the super fans and maybe had a smaller target addressable market, but with probably maybe higher prices, that's probably a better outcome for shareholders, right? So I keep asking that question: is this the right path for Disney? And as company keeps saying, we're happy with where we're going. And I kind of wonder if they set targets themselves that are not achievable or will require too much investment to get there.
So rather than the race to acquire more market share right now among the streaming players like Disney, like Netflix, like some of the other media companies that have launched their own platforms and services, it's really more about path to profitability now?
Yeah, Disney has a unique set of assets, right? That's why they launched so well. That's why they have such great pent-up demand. And my worry is as you move further into where Netflix, HBO Max, Amazon, Apple play, the returns go down, right? So we thought the first investor day they had where they pretty much, unveiled the first Disney Plus strategy of playing to their fans, that makes sense to me. I know it could result in lower subscribers, but it's probably a better business than where they're going today.
Debate regarding the nature, the qualitative nature of their content, Michael, is the Disney umbrella, the family-friendly Disney umbrella, an inhibitor to big global sub-growth, right? You're not going to get horror, and you're not going to get sort of adult content that you get on rival streaming platforms. Obviously, that's not going to change, right?
Right. Well, Carl, that's right. But look at how quickly they scale their business, right? Look how quickly they got to over 100 million subs. And you could, say maybe some of that's India, but, they have a great hand. And my worry is the return on investments needed to get to that next level, which may include getting more cricket rights, just not as profitable a path as if they played to their strength, right? That's a question that we ask. But again, to Morgan's question, the stock has come in tremendously. We now can evaluate it on more traditional metrics than using revenue multiples. So it's entering a zone where you can get some valuation support, which is what I look for.
Meantime, the theme parks, that unit revenue doubled year over year, thanks to, in part to that new line skipping system. And I realize that there's going to be some softness in China around the theme parks, but why is that not getting more attention? Because on the one hand, yes, you can talk about streaming and this idea of, pandemic, stay at home, return to normal situation where streaming is concerned. And by the way, not just at Disney, but on the other hand, with the theme parks, it's a reopening recovery play, no?
No, that is. But Morgan, we know how to value the theme parks. We've seen the theme parks before. We have an idea of what the margins look like and what the returns should normal look like. The move in the stock has really been about what's the value of streaming, right? With Netflix falling as much as it has, it's really about how do you value streaming? How far ahead do you want to look? What's the steady state profitability? And we have a 40-year history of the parks, right? So that's not a surprise to us. It's really about how the market's grappling with what is this, the end state of the streaming business look like, and what's the return on invested capital of that business, right? That is, to me, the volatility on the stock. It's not the park business. It's just not.
Yeah.